Coming up today, stocks surge across the board, led by semiconductors. The queen of stocks loads up on NVIDIA. Can the great rotation continue? A look at Meta's earnings, why the Fed is about to cut rates, Israel kills the leader of Hamas, the knock-on effects to the oil market, along with gold hitting new all-time highs, and the latest investment recommendations from billionaire Bill Gross. It's a big one today, guys. Let's go. And welcome back everybody to the channel. On this huge day in financial markets, we have got quite a lot going on today. If you haven't already, smash that like and subscribe button, and I'll keep you updated every day on what's happening across financial markets to help you make better financial decisions by staying informed on everything that's going on out there. And so we had a really good bounce in the market today. S&P 500 up 1.5%, now back above 5,500, starting to show a lot of green across the market up the front. Led today by none other than mega cap tech, having a really nice bounce here, taking the Nasdaq up almost 3% in the regular session, and we're still ripping higher after hours as I speak, up 71 basis points. What's really driving the action right now is we just got earnings from Meta. Coming in with some good numbers, just going down to the 5-minute chart after hours, we are trading up strongly, currently up 6.7% as I speak. Also saw a huge bounce back today in NVIDIA and other semiconductor companies. Been really weak this last couple of weeks, come down to the support level, and we've seen some really good bounces today. Kicked off by AMD's earnings. Last night, we were initially selling down after hours thanks to Microsoft, which at one point yesterday after hours got down to 389. Before finding support, did a sharp buy the dip after hours and almost reclaimed all of those losses really quickly, showing there's a lot of money just waiting on the sidelines, and it's not hard to see why. Microsoft is still super strong, still growing really well, even though they did just meet expectations. I'd say any further weakness over the coming days could be another buy the dip opportunity on Microsoft for a swing trade back to the 50-day VWAP. And we're still technically oversold on some of the other hot stocks. Supermicro Computer has really got to defend these levels if it wants to hold on to this uptrend and consolidation. Also got earnings out today from Qualcomm, up 8.3%. Broadcom tacking on almost 12% in today's session, and just overall the semiconductor sector was the clear standout and winner today. As a whole, up 7.6%, tracking higher after hours, and we may have just defended that support zone I've had drawn in here for the last week. Got some really good volume, momentum thrust upwards, along with the whole tech sector. Also saw a nice move higher today in precious metals, gold breaking out to all-time highs. On rising tensions coming out of the Middle East, we've got news today, Israel has taken out leaders, both Hamas and Hezbollah, all of which I'll get into later and let you know the details about, and the potential knock-on effects to commodity markets. We've still got Bitcoin pulling back a little bit here on shallow volume. We'll be looking for it to find support around the 50-day VWAP, around 63,000 a coin. Got a nice move higher today in high-yield bonds on volume. That's a new 52-week high. Really bullish risk sentiment out there across markets. And look at that dive in the government bond 2-year yield, now at 426, a full 100 basis points between that and the current Fed funds rate. Something else I'll dive into today, the latest from J. Powell. And of course, market breadth is still accelerating. Number of stocks hitting new yearly highs versus new lows, and more than 3/4 of all S&P stocks above the 50-day average. So stick with me today. I got a real interesting one for you, including some funds Bill Gross has just recommended on his Twitter. I'll show you a few of them. But just quickly, before I get into the daily market review, I'm just proud to share with you guys, Click Capital and myself have just been mentioned on Bazinga, one of the most popular financial news websites out there, where they have shared with their readers my new stock pick service and $1 Million Investing Challenge. For those of you who don't know, I've started a brand new trading account where I'll be buying $500 of a stock every Monday and sharing those stock picks with paid members the day before on Sunday morning. So anybody can follow my stock picks and trading account in real time. And since today's the last trading day for the month of July, thought I'd just give you guys a quick update on how it's tracking. So far so good. We're in the green, and in fact already well ahead of the S&P 500. Just looking at a time-weighted return, which is the best way to measure returns and taking into account cash flows, since I'm dollar cost averaging every week. And so far, so good. Portfolio currently up 6.27% versus the S&P 500, up 2.4%. And so all members today will get the monthly portfolio performance report, and I'll give some deeper insights and commentary on how the portfolio is tracking, along with my current investment. And for anybody else who is interested in joining the journey, or if you've been thinking about joining, now's the time to act, because in a bit over a week, I'm removing lifetime pricing and switching over to monthly and yearly pricing, as lifetime pricing is simply unsustainable when you're growing really quickly. And so for the next week only, you can save 25% off the cost of a lifetime membership by using coupon code LAST25, and you'll just pay a one-time fee of $577, and you'll get my weekly stock pick and research every week for the next 10 years, along with access to the private members area, where you can track all my account performance, weekly updated statistics, and you'll get to see a record and log of everything that's being sent to members all current open picks, how they're tracking, along with links to all my previous picks. Everything's shown inside there. I challenge anybody to find another trading membership out there that gives as much transparency as mine does. I send out all my picks before I make the trade in my account and upload all screenshots from my brokerage account. And my track record is 100% transparent. Unlike other trading memberships, they just give you vague trading ideas or alerts. And so my goal with this service is to turn my brand new account into $1 million in under 10 years, all in front of your eyes, by being completely transparent with you the whole journey, sharing with you all the ups and downs on my way to taking this brand new account to $1 million. So if you'd like to join that, click the link below this video, head on over to my website, clickcapital.io, click on the red banner up the top, and use coupon code LAST25 to take advantage of my lifetime pricing before I remove it in a week's time. And the same goes for my product packages. If you'd also like to get my custom trading view indicators, trading bot, or online course, now's your last chance to get all of that for a one-time lifetime fee with 25% off using coupon code LAST25. All packages will soon be moving to yearly pricing as well, so I can continue providing everyone with quality customer service. So if you'd like to pick up a package of mine for 25% off, click the link below this video and take advantage of this special today. Okay, just getting back into the daily market review. It's not really surprising to see NVIDIA surge up here today. Like I've been saying, they're the biggest beneficiary of the AI boom. This huge capex by mega cap tech. It's up to all the other companies to turn all this hardware into a profit. NVIDIA's the picks and shovels supplier of this boom. These big tech companies have so much money to spend, and they're all racing each other in kind of an arms race to see who can gain the most compute power and power all of their products and the back ends of their businesses as well. And even though we were falling pretty hard yesterday on Microsoft, just to begin with, there was a big buy the dip, and that was helped out by AMD's earnings. Coming in better than expected, analysts becoming more bullish, increasing their price targets, and this stock had been beaten down with some other second tier semis as well. So that's pretty good price action to see them really bounce well today. And we've seen Morgan Stanley name NVIDIA their top semi pick, and more important technically, we saw that bullish breadth across the board. The whole sector ripped up, every stock within it. And so that's something we'd really been looking for this week, is whether mega cap tech can bounce back, hold their line of support, and so far so good. However, don't neglect what's been trading really well the last month as well. Small caps, value stocks, and dividend paying stocks. Bit of a forgotten segment of the market as they've been underperforming for so long. Bank of America says they're poised to surge on the back of $6 trillion sitting in money market funds that's about to start earning less once the Fed starts cutting rates. And as long as the economy holds up, then dividend stocks are going to start looking a lot better to investors when you can still get 4 or 5% out there. If all of a sudden a lot of investors, institutional, retired boomers, and the like start noticing their monthly fixed income payments dropping a little lower, they might go hunting around for where they can replenish that. So it could be a case of, instead of a massive rotation, maybe we're going to go back to the good old days of an everything rally. As according to Man Group, the Magnificent Seven are not outrageously priced. The recent sell-off has brought their valuations down to more reasonable levels. And in their opinion, valuations are now akin to acquiring mid-single digit returns over the next decade, with them still expecting good growth and free cash flows in them all. Who's also really confident in the ability for the Magnificent Seven to continue winning is one of the most followed Congress members when it comes to her investing activities, along with her husband, Nancy Pelosi, just disclosed the purchase of more NVIDIA shares, won about $1.5 million, while also trimming her Microsoft stake. She's been one of the best performing Congress members over the last couple of years, and that's why she is highly tracked. Other companies she owns, Broadcom and cybersecurity companies as well. The Pelosi's are still heavily betting on semiconductors and cybersecurity here. So now that mega cap tech is bouncing back, does that mean we're going to see a bit of a pullback in small caps? Was that just a blip, what we saw the last month? Or can the great rotation continue and they will lead this new phase of the market higher? Well, there's still challenges ahead. They're not as big a beneficiary as the AI boom, as obviously the mega cap techs are. However, they are expected to have better earnings growth next year because their cost of capital is going to come down when the Fed cuts rates. Their bottom lines are more sensitive to the Fed funds rate. And with the starting valuation and the valuation gap with large caps, there is still room to run for sure. And like this great chart shared by Fundstrat, shows the spread between the Russell and S&P 500 over the course of this month has tracked pretty closely the pricing by the market of the number of Fed cuts by December this year. So without a doubt, small caps, as I've been saying, have been trading really well on the market, pricing in imminent cuts by the Fed. And once again, seasonality's played out. We finished higher for the month of July in the S&P 500. Didn't quite come in at 3.1%. It was a bit over 1%. And again, looking back in history, we can see a little bit of weakness in August and September, which we still can't rule out even with this sharp bounce back today. We may just grind sideways for a week or two before rolling over again. That wouldn't be surprising. And what you're looking at here is some data. When the S&P 500 hits a new all-time high in July, what are their average returns going forward? Just looking back in history of 18 instances that's occurred before. In fact, when that happens, like it's just happened now, S&P 500 only finishes August higher 27% of the time, and for the next 2 months, it's a 50-50. 3 months, it's even lower. So looking back in history, we shouldn't be surprised to see the market trade weak in August, September, and October. However, once we go out to November, December, we're higher 83% of the time. 12 months out, we're higher 72% of the time, with average gains just under 7%. Also interesting to note is hedge funds' exposure to cyclical versus defensive sectors is at an all-time low. Means they're not betting on the growth sectors. Instead, they're more positioned in defensives. So that could be a big unwind and a lot of ammo left for cyclicals like consumer discretionary, energy, and materials. Some sectors that haven't been performing as well this year could have a lot of catching up to do. But for the here and now, mega cap tech is in the spotlight, and we just had Meta's earnings after the bell as I speak, coming in pretty good. Revenue increasing by 22%, earnings by 73%, daily active users rose 7% year over year. 3.3 billion people use Meta products every day. That's almost half the world's population using a Meta product every day. Reported revenue of $39 billion and earnings of $5.16 per share. Beating analyst expectations. Costs only increased 7%. Headcount reduced. Future projections. Meta expects 24% revenue growth for the September quarter, and they're still expecting significant capex growth in 2025. And since they're a huge customer of NVIDIA, I'd say that's why NVIDIA is doing well today. Mark Zuckerberg is pressing the gas on investing in AI because they're all worried more about underinvesting than they are overinvesting. There's only sensitive bears out there that are worried too much about the here and now of what they're spending. They do plan on adding more people back to their team by the end of this year, and the market doesn't seem to mind that they're not going to generate much revenue from their AI products this year. This is a long-term plan. Like I said, they're more concerned with building out capacity than worried about potentially losing 30-40 billion, which in the long run, with these trillion-dollar market caps, pretty much a drop in the bucket. Surprisingly, Threads is still holding up, hitting 200 million monthly users. Mark Zuckerberg says Facebook isn't just for older people. And there's a look at its long-term revenue growth, year-over-year percentage change. It really got the market spooked. In 2022, they were spending big on the metaverse, virtual reality, and their revenue started going negative. Stock came off super hard. Mark Zuckerberg went on a cost-cutting mission, got back to growth, and we've seen one of the biggest turnarounds in the large cap space for a long time, and they've got their revenue growth back above 20%. The market's kind of looking for the same pattern here in Apple, which we'll get to hear from tomorrow after the close. And the market doesn't mind that they've got accelerating losses in their Reality Labs division, building out for the future. Could very well be the leader in VR, the metaverse, and another area they're heavily investing. And it's going back to the 5-minute chart on Meta after hours as I speak, doing even better, up 7.3%. Currently tracking around 509, around here on the chart. Still a little bit off those 52-week highs of 544, but nonetheless, constructive price action, and looks like this support zone down here is not even going to get tested. Big ones tomorrow, like I said, Apple expected to deliver $1.34 in earnings per share. This has been trading really well the last couple of months. It'll be really interesting to see what they come out with, along with Amazon. Make sure you come back to this channel tomorrow night and I'll give you the rundown on Apple and Amazon and what effect that's having on the market. Right now, the Qs are loving it, up almost 1% after hours. It's an almost 4% move just today off yesterday's close. Shows how quick the market can pivot and turn. Now just moving over to global macro, inflation, interest rates, and the bond market. So we had the Federal Reserve meeting today. They kept interest rates on hold, but we heard some updated language and commentary from the Fed Chair Jay Powell. Said recent progress on cooling inflation in Q2 is better than the steep disinflation of late 2023. He said current disinflation quality is higher compared to last year, and that there's been broader disinflation this year. And this is a look at their updated official statement. Lined out in the red is what was there in the last statement, and here's the new words. Job gains have moderated, and the employment rate has moved up but remains low. In recent months, there has been some further progress towards the committee's 2% inflation objective, so on and so forth. So they basically did get a bit dovish. They like what they see on inflation. And like I've been talking about, they have to consider at least the perception that this is politically driven. I don't really think it is at this point. I did a few months ago, thought it could be. However, the data is actually there for Jay to cut. So I won't be criticizing him if he does, but for sure he's going to face a lot of criticism as it doesn't look good on the surface. But like I've been saying, it looks pretty much guaranteed we're going to get a cut in September. He's pretty much opened the door and indicated to the market that he could be on the cusp of doing that. I'd say for that to be upset, we'd have to get a real surprise print over the next couple of weeks. And just looking at the bond market, commodity market, economic data, that seems unlikely at this stage. Although what's happening in the Middle East could potentially change things but we won't see that flow through into economic prints for a few months yet. So as always, he's got to walk the line of easing too soon versus waiting too long. And so just looking at some historical data, what happens to the S&P 500 when the Fed starts cutting? Well, if the economy holds up, so will the S&P 500. Quite obvious. However, if we go into a recession, then the stock market can typically come off hard in a recession. However, there seems to be a misconception out there that when the Fed starts cutting rates, we always go into a recession. And that's just simply not the case. And I'll demonstrate that to you right here and now. Currently looking at a monthly line chart of the Fed funds rate. There we are at the midpoint, 533, and we've been there since August last year. Starting to get to historic extremes now for how long the Fed has been on hold. Shaded in the grey is when the US has gone into recessions. We had a sharp one there in COVID in 2020. And so when the blue line starts decreasing, that's when the Fed started cutting rates. And so the Fed already started cutting rates in August 2019. They didn't know COVID was coming. And so that could be argued that the recession didn't occur because of the Fed rate cuts. However, technically it did, so I'm happy to say that we did get a recession after those Fed rate cuts, even though correlation versus causation could be argued. Going back again, well, it was a clear sign back in 2007. They cut in August because there was big problems brewing in the banks, subprime mortgage market, real estate, so that for sure is a clean-cut signal of the recession happening shortly after the Fed started cutting rates. Let's go back again. Back at the height of the tech boom in 2000. They started cutting rates in early 2001. We did have that recession. However, rates stabilized for a while, and then they started cutting them again in 2002, and they cut them again in 2003, and we got no recession. It was actually near the low of the stock market and went on to have a really good 4-year bull market after that. Also again, in 1998, they cut rates several times. Stock market went on to rally for another couple of years. Same again in the mid-90s, 1995. Going into 1996, they cut rates. One of the best performances of the stock market of all time, mid-late 90s, and they were cutting rates during that time. Going back into the early 90s, savings and loans crisis in the banks, they did cut rates. We did get a recession back then, but they kept cutting rates after the recession. Stock market continued to roar. And again, in the mid-80s, we saw big rate cuts from the Fed, and apart from a brief little crash in 87, the economy didn't go into recession. That was a good time for the stock market. So again, just to clear up the misconception, when the Fed starts cutting rates, all hell is about to break loose is not guaranteed. As I've just showed you looking back in history, bull markets can continue or even start after the Fed has cut rates. And like I've been saying, looking at the price action in the bond market, it is convinced that the Fed's going to not only start cutting in September, but it's going to keep cutting pretty much every quarter for about a year. You can see that in Fed Fund futures now, pricing in a greater than 100% chance they will have cut come September 18, and now looking better than 3/4 chance they'll cut again in November, pretty much saying we're guaranteed another cut by December and continuing into next year. So if the economy holds up, unemployment doesn't spike, this is a Goldilocks scenario, this is a soft landing, this is strong structural tailwind with the stock market, along with growing earnings, corporate buybacks, and the continued huge capex spending on AI. And so along with a tailwind for the equity market, like I said, we could really be getting back to the good old days of an everything rally. And just maybe the historic longest bear market in the bond market history, 250 years of US bonds trading, may already be over. Just looking at previous bear markets and long duration treasuries, this one was a whopper. 907 trading days before it found a low, easily outpacing historic bear markets. And here's a look at the long-term monthly chart on TLT, long duration treasuries. You can see ever since it started trading over 20 years ago, had that huge tailwind of decreasing interest rates, had a few swings in there, did really well in the recessions, so it is a good hedge. As long duration bonds are more sensitive to changes in interest rates, and just looking at the technical price action, we may have just completed Stage 1 accumulation, going into the sweet spot, Stage 2 advance, breaking out of this months-long downward trend line, huge accumulation and volume signs, and this could be a win either way bet. Interest rates get cut because of inflation coming down, that's going to give it a tailwind. Or if we do get the recession next year, which is still a real possibility, then interest rates are really going to get cut hard and it could spike up just like it did back in 2008. We had a lot of problems in the economy. And just going out to the weekly chart, really constructive price action here. May not be a bad idea to have a little bit of long duration. Not a bad starting valuation, good technical price action, and I'd say there's some pretty good macro tailwinds as well. Looking good also as short-dated bonds. Still trading in a bit of a box here, however they could break out as well come September when the Fed starts cutting. We also just heard from Bank of Japan yesterday, came out with a little bit of surprise and hiked their rates from 0.1% to 0.25%. So they're getting pretty worried about their weak yen, trying to get underneath it as they continue to unwind their quarter-century-old monetary stimulus, having ended its negative interest rate policy in March. He hinted at the market more hikes could come, trying to really get behind the yen here. Narrow the interest rate gap between Japanese and the US, and with the Fed likely to pull back, that should help stabilize the yen. However, coming off these rock bottom lows, so it's going to be a long time before they can normalize their rates. And they've also been intervening directly in the currency market, buying up the yen, putting a bid underneath there, trying to go against traders, momentum, and it's been working. Another big leg down today for the dollar yen, and just going out to a monthly chart, still got a lot of work to do. Dollar's been super strong since the yen for the last couple of years. So again, it looks like all those fears a couple of weeks ago, people calling for the yen to blow up the entire global financial system, once again didn't pan out too well. And now we're hearing fears of the other way, the unwinding of the carry trade is going to blow things up. Well, again, Japanese interest rates are 0.25%. Don't think the carry trade is going anywhere anytime soon. And if things get bad enough, then get ready for some new liquidity from the central banks, which is bullish. Later on tonight, we're going to hear from the Bank of England with their interest rate decision. Big week for global central banks. Economists predicting a move from 5.25% to 5%. Still inflation concerns out there. Got the headline inflation stabilizing at 2%. Services inflation still remains high. Financial markets view the decision as a 50-50. It'll be interesting to see what they come out with. May want to get in front of the Fed. Also interesting to note that Eurozone inflation came in a little hot. Unexpectedly rose 2.6%. However, that's just a 1 month read. That's why we look at moving averages to smooth out the data. Look at the trend. There's still disinflation. And since they don't have the growth of the states, they definitely have room to keep cutting as well. Okay, over to geopolitics and the knock-on effect to commodity markets. For those of you who don't know, last week we saw an attack on Israel that killed over a dozen children playing sport. Israel approved a retaliatory strike on Hezbollah, which as promised they carried out, killing the leader of Hamas directly inside Iran in their capital Tehran, in quite a bold move and strike, taking out another key figure from the Iranian regime. They also killed the leader of Hezbollah in Beirut. This is on top of the strike they did a few months ago. They took out more military leaders in an Iranian embassy in Syria. Trump also killed the previous Iranian military leader in his first term. And the Israelis this time did it with amazing precision. There's a shot of the building in Tehran where the Hamas leader, along with his bodyguard, were eliminated with a strike coming directly into the window where he's sleeping overnight. And so those surrounding the dictator of Iran keep getting deleted. He keeps effing around with Israel in the West and keeps finding out. With them sending a clear message, we can take any of you out from the sky, no problems at all. And of course, just like last time, after Israel took out 7 military commanders, Iran said Israel will pay a heavy price and that they will strike back. However, last time they sent 350 missiles into Israel, and they, along with the help of the West, pretty much shot them all down out of the sky. None got through. So it'll be interesting to see what Iran comes back with this time, and more importantly, the knock-on effects to financial markets and us investors. Regular daily viewers know I've always been warning that this hasn't gone away, bubbling away in the background. Let's not forget the millennia-long war between Arabs and Jews isn't going to disappear overnight either. In fact, it's the most heightened we've ever seen it in our lifetimes. So for the here and now, commodity markets have definitely reacted. We just got the biggest gain in months in crude oil futures. As I'd say, they'd be pricing in a potential big response to Iran. However, like I said, Iran's last attempt wasn't successful at all. So it might be interesting to see if they step it up this time, try something different, or exactly what's going to happen. Because they have to respond, otherwise they look weak. And I'll say it again, this may just have to reach a blow off top for it to be resolved. And we seem to be barreling towards a full-on war between Iran and Israel, in which it's almost certain that Iran will be defeated thanks to the help of the West, who in my opinion is looking for any good excuse to shut them down once and for all, as they've been poking away not only at Israel, but at the West for many decades now, and they may just need to cut off the snake's head once and for all and take out the dictator. Also saw a bit of a flight to safety to gold, breaking out to fresh all-time highs. It's a great hedge for wars and inflation. Also likes the prospects of lower Fed rate cuts as well, competes with investors' money as a yieldless asset. And there's a look at crude oil, bouncing beautifully off technically oversold levels we got yesterday, ripping up almost 5% today, 78.50 a barrel. There's gold making fresh highs, and silver got a little bit more catching up to do. What's helping to keep the overall commodity complex a little soft here is agriculturals. Still testing the support zone, and we've still got some weakness in natty gas. And just moving on today to a post from Bill Gross, which I found interesting. I thought I'd share with you guys. He was the former Bond King. Billionaire investor, said closed-end muni bond funds sponsored by Nuveen and Invesco, among others, recently raised dividends and now yield around 7% federally tax-free. He did obviously say consult your broker or tax attorney, and as always, this is not financial advice, just my opinion, sharing my research and what I'm seeing out there. He pointed to some choices like VMO, VKI, VKQ, NZF, NFG, as well as KTF, as being closed-end funds that he's owned for years, and he's added to in recent months. And so there's a look at VMO. And just going out to a monthly chart, it's been a serial underperformer for so long now. A lot of these close-end managed funds, mortgage-backed securities, just gone nowhere. So it's quite a contrarian call. And for those of you who don't know, a closed-end fund is basically a product where they'll raise money and they'll invest it in assets, and it's closed to any new capital. They won't issue new shares. They'll just distribute dividends and income from the assets they're invested in. And so they can come with tax advantages, can be quite sensitive to interest rates as well. We saw them get smashed in 2022. And again, they're another forgotten area of the market. So I thought that was interesting to hear Bill Gross quite bullish on them, considering how bad they've traded for a long time and how volatile they are. Saw it come off in 2021 from $14 a share, almost get cut in half. However, they could perform well along with REITs and other interest rate sensitive sectors if the Fed does begin a rate cutting cycle that persists into next year. There's a look at the economic calendar for today. The retail sales in Australia a bit better than expected, along with inflation data. CPI pretty much coming in line as expected. Weighted median CPI year over year 4.1%. There's Japan's surprise interest rate decision, along with Eurozone inflation coming in a little hotter than expected. ADP employment in the States coming in a bit softer than expected. Little softness in the jobs market there. Amount of homes being sold in the States still coming off. Inventory growing. The Fed rate decision. And then looking out till tomorrow, manufacturing PMIs across the Eurozone and the States. And then the Friday, the big one, jobs report, unemployment rate expected to come in 4.1%. And the post-market sessions just closed. Meta finishing at 508, up a bit over 7% after its good earnings. Now back above its 50-day VWAP, trading around here. So we'll see how that goes tomorrow. And then make sure you come back tomorrow for the big ones, Apple and Amazon. We'll see what sort of moves we get out of them and how that plays into the market. Otherwise, the big news for today was Jay Powell leaning more towards our indications that he's going to start cutting rates, and we can see that in the 2-year government bond yield. Nose diving again today, walking the line lower, 426. Getting the S&P 500 back above its 50-day VWAP. Thanks very much for tuning in with me today. This interesting week is continuing, and I hope to see you back here again this time tomorrow. Cheers.